Hi students, this is Mr. Jason, and so far we have covered all the different categories of ratios in this chapter. And in page 289, basically we are going to go through the limitations of ratio analysis. It is important to understand that even though we need to know how to calculate ratios and interpret them, but there are limitations to this analysis, and let me go through them one by one. So a ratio gives an indication of one aspect of the business performance. For example, if I calculate profit margin ratio, then I will only know the profit margin of the business. I don't know anything else, right? I need to use the ratios with reference to other ratios. Sometimes I need to refer to trends as well, because ratios by themselves may not be able to interpret the business situation at that time. I need to look at past years, I need to look at industry averages, I need to look at similar companies, right? So these are some of the limitations. Let's go through the list of limitations, so many of them. So one of them would be that ratios are indicators of performance at one point in time. It might be out of date. So this is a historical limitation. This is because whenever you calculate ratios, you're calculating them based on past financial information. So by the time you calculate them, it might be out of date. It might be obsolete, because new figures are going to be churned. The second limitation is that there is a limited availability of data, because sometimes companies don't disclose everything. So if let's say you want to calculate a ratio, but then you can't calculate it because you don't have the information, then it is impossible to calculate it, right? The third limitation, unless reports are in a common format, time frame and currency, comparison is difficult, especially if you want to compare between companies. Now, if companies change their accounting policies, then you cannot compare past ratios with current ones, because there'll be a difference in the way you treat accounting items like asset valuations. Sometimes companies want to manipulate policies. They will window dress their items or amounts so that they get the best ratio results, and this is misleading. Because when you do this, comparison would be misleading because each company has their own policies, own management. I'll give you an example, like depreciation. We know that there are two ways to calculate it. And if two different companies use two different ways to calculate depreciation, of course this will affect expenses, it will affect profit. So it will affect some of the ratios already. So comparing these ratios just like that can be misleading. Now, ratios are only as reliable as the accounting information, right? So if let's say the accounting information is wrong, then the ratio will be wrong. For example, doubtful debts and depreciation, they are based on estimates. They are not actual figures. They are forecasted figures. They are estimations. So if those estimates are not accurate, then the ratios are also not accurate because they are based on this data. Ratios identify problems. For example, if we have high gearing, we know that there is a risk of repayment, right, of loan. But it does not explain the reason why it is high. It can be due to high liabilities, low equity, and things like that. But we don't know the exact cause. We need to look at the financial information to figure out more. Ratios are calculated based on historical costs for non-current assets. Like I said, when it is based on historical figures or past data, sometimes the figures may have changed. For example, for non-current assets, we know that there might be changes in market values, there might be appreciation, there might be inflation. So this is something that is not taken into account when we calculate ratios. Now, there's so many limitations here, but I just want to say that these limitations can be overcome if we look at this whole topic, this whole chapter, as a supplement to whatever we have learned before in our financial statements. They are just indicators that are used in conjunction with other sources of information, with other analysis. So we cannot use this by itself, but we can use this to complement and supplement other information we have to make more informed decisions, because that's what accounting really is about.